Hi everyone, and thanks for joining us today. My name is Anthony Palmer, Group Commercial Director for Carrick, and I'm joined by Rex Cowley, co-founder of Overseas Trust and Pension, often referred to as OTAP, a company I've worked very closely with for over 8 years now, and in my opinion are absolute leaders in this particular field. We've got a nice group of participants today, ranging across the board from existing clients to potential clients looking to learn a little more about the various options, and in particular, the subject matter of today being international pensions. The webinar will be around 45 minutes with a question and answer session at the end, so please feel free to post your questions and we will endeavor to answer as many as we can. For those of you that don't already know Carrick, we are a boutique financial advisory and wealth management firm, often actually referred to as the offshore guys. However, we also do offer a full suite of South African investment, retirement, estate planning and risk products, which allows us to adopt a whole portfolio approach when advising our clients. We are regulated and have offices here in South Africa, Mauritius, the UK, Zimbabwe and Malawi, with plans to open further offices across Africa. A little bit about Overseas Trust and Pension. They are a specialist provider of international trust and retirement solutions for corporates as well as for individuals. They've got over 6,000 clients and over $2 billion of assets under administration, which certainly makes them one of the top providers in the Channel Islands. They are regulated here in South Africa as well as in Guernsey, and their client base includes blue chip companies that are listed on the S&P 500 as well as the NASDAQ. As mentioned, Rex is co-founder of Overseas Trust and Pension. He has 31 years of experience in the wealth management industry and is seen as a thought leader in the international retirement space. Thanks again for joining us today, Rex. It really is great to have you with us.
Absolute pleasure, Anthony, and looking forward to the seminar.
Great. So Rex and I both personally spent many years working abroad, and both decided to come home to lovely South Africa to be closer with our families, to be closer with our friends, and to take advantage of strong business opportunities here in South Africa. But from that experience of living abroad and coming back home, I think we both know firsthand how true that saying is of live in a warm climate, but keep your assets in a cold one. I mean, I came back in 2009, and I've seen the rand devalue by over 100% now. It was around about 7 rand to the dollar when I came back, and now you need 14 rand to buy that same dollar. And I guess that's the crux of today's discussion: how to keep your wealth safe and maintain your global buying power. But the question remains as to how best to achieve that goal. And hopefully today's webinar will provide some valuable insight into just that. This is not something unique to South Africans, and no one has to feel unpatriotic or nervous in moving assets offshore. As most of our listeners know, you are allowed legally to externalize up to 11 million rand per person per year. It's a 1 million rand discretionary allowance and an additional 10 million rand investment allowance. And South Africans are actually very far behind the curve in this respect. There was a recent survey that said that high net worths in South Africa have on average 12% of their assets outside of the country. And to put that in context, high net worths in Australia, other developed market nations have over 70%, 70% of their assets outside the country that they live. So clearly some catching up that us South Africans have. We all know there's a large ocean of possibilities out there, and fishing in a small pond that makes up 1% of the world's GDP may feel safer and more familiar, but certainly comes with its share of risks. That being said, the increased opportunity in going offshore also comes with increased complexity, especially as cross-border investing opens up a myriad of potential pitfalls that need to be explained, understood, and also successfully navigated. Fundamentally, I think that's what the webinar today is about: the right to protect and preserve your financial future. So, what are the options available when it comes to investing offshore? These do range very, very widely, from investing in your own name, so you can keep your money in South Africa and use feeder funds to go offshore, or you can use asset swaps, or you can externalize using the above mentioned reserve bank allowances, to using structures such as international endowments, international trusts, international companies, and international pensions. At Carrick, we put all of these options on the table and we jointly decide which one best fits your needs and objectives. But today, as I mentioned, we're going to focus specifically on international pensions, as they are, in my mind, one of the most elegant and powerful solutions available and can pretty much tick every box needed. So Rex, apologies for the long intro, but I did need to paint the picture. Over to you, Rex, if you can explain to us and to our audience what an international pension actually is and how it works.
Yeah, thanks, Anthony. I think international pensions come in lots of different shapes and sizes, but I suppose what makes them an international pension is effectively that they're a pension offered from a country other than South Africa. So a lot of people will work overseas, work for an employer, they'll have a foreign pension in that country, etc. But I suppose what we're going to be talking about today in particular is a personal pension scheme. So international pensions, which are personal pension schemes, in other words, something that you take out in your own name and that you fund. So I think that's what we're really going to be talking about today. And if you look at how they're structured, they're incredibly similar to what we see domestically. You'd apply for membership to a scheme. Once your membership is accepted, you can make a contribution to that. You invest your funds, and at a certain point in time, you get to your retirement age or your benefit date, and from that point in time, you can take a benefit from it. Again, these arrangements are irrevocable, so they're very similar to a domestic scheme. You can't just collapse the scheme. You have to abide by the rules, and there's different benefit options that are available. So very, very akin to what you'd see in a domestic scheme. Benefit types from lump sums to annuities to regular payments. And of course, a death benefit when you pass away, Anthony. So yeah, I think if you consider what you get with a South African scheme, a domestic South African scheme, it'll be very similar from an international perspective. I suppose the main differences really is the contributions you make to an international scheme don't receive tax relief. However, the flip side of that is that the investments don't have the same constraints as a local plan. So you can fully invest in hard currency and you can fully invest into international investment opportunities. So on the one hand, you're giving up the tax relief, but on the other hand, you're getting that investment and currency freedom, which is actually what it's really about. And of course, with international schemes, once you get to your retirement age, there's significantly more flexibility there, Anthony, in that you can actually effectively cash the entire scheme in. So you have 100% access when you get to that age that you wish to retire, which again, you don't really have that flexibility on South African schemes without unless you're emigrating, etc. So those are, I suppose, are the key similarities and differences. The only final point I would make is that when you consider the international scheme versus a domestic scheme, international schemes aren't there to replace your domestic scheme. I think they're very, very much something that's there to complement any domestic pension provision. So I don't think one should look at them as an either or, Anthony. It's an extension in respect of your financial planning.
Yeah, I guess that also comes down to your individual circumstances, and that's part of what we do. Is work out suitability and trying to keep matching assets and liabilities is important. If you're living in South Africa and spending rands, you need to make sure that you've got sufficient rand income as well. Rex, you mentioned that an international pension has got broader application in respect of financial planning, which we've touched on. But from your perspective, what are the main reasons that clients are opting for these pensions? And other, I guess, other principal advantages of using them?
Okay, I think to me this is the real exciting bit, and I suppose there's two ways of looking at it. We can look at some of the actual benefits of the scheme, the features and benefits, and I'll come on to those. But I think if primarily we look at what's important for customers, we sort of see a number of different themes. And these are the things that really matter to us as people. I think the themes that we generally see is this desire for a certain sector of society. They really do not want to see their wealth diminish on a global stage. So you've spent a lot of time building up your wealth. I think your point, Anthony, when you came back to SA, you've seen the rand devalue by 100%. So effectively, you've lost significant purchasing power as a global citizen, and we live in a global village. We can travel more than we ever used to be able to, COVID permitting, obviously. But generally, the borders pretty much don't exist these days in terms of where we choose to live or work. So I think for South Africans, there's a significant desire, as I said, to internationalize wealth so that you can preserve the value of your wealth. So that's one thing we see. International pensions allow you to do that so that you can mitigate that economic risk that's associated with emerging market currencies. So that's one theme that we see coming through very strongly. The other one is really risk mitigation. And this is to do with things such as political risk. You know, what are the policies of the country that you're in? How might that affect your wealth in the future? And I think there's a lot of people that have concerns around policy, you know, with regards to wealth in South Africa, and therefore the desire to put your assets into a structure that are protected from I suppose, from political risk is a big driver. But also entrepreneurs, self-made business people, people that take commercial risk on a daily basis, exposing themselves to the potential downside of that risk, like to have an environment where they can mitigate that commercial risk in respect to their daily lives. So if the catastrophe event happens and they get wiped out financially, when the dust settles, the foreign pension scheme is 100% protected, whether that catastrophe was down to policy at government level, or it was a business interest or something that occurred. Third-party claims are fully protected. So I think you've got this internationalization on the one hand, you've got risk mitigation on the other, and the other one, it's about certainty for the family. So there we see people that have accumulated wealth. They want to internationalize that wealth, but really it's about if something happens to them, it's the certainty that those assets are going to be passed on to the people that they want them to be passed on in the way that they want them to be passed on. I think that's where international pensions have significant flexibility in that that succession piece is dealt with very, very neatly through the pension scheme. And I suppose if you draw all of that together, it doesn't matter which one of those camps you sort of fall into, it comes down to peace of mind. People want peace of mind with regards to their circumstances and those things that they worry about. They want to be able to mitigate those worries. So I think that's the strategic reasons why people are using international pensions. At least that's what we see. If you look at some of the basic benefits, and I think, you know, there's the obvious certain tax advantages to using pension schemes, whether you're using a domestic one or an international one, that you will get certain tax benefits, tax roll-up, for example, on the assets, which makes the portfolios obviously efficient. You know, you haven't got a constant tax drain on the investment gain. So you get your roll-up environment, which is obviously attractive. There's no cap on how much you can put in. There's no restrictions to stop and start your contributions. So there's no penalties around that. So you can really fund it and manage it at a rate that suits you. And of course, you've got the investment freedom, the currency freedom that we touched on earlier. So those are some of the practical advantages. And of course, on passing, you've got the ability to have those assets moved over to your dependents or beneficiaries very, very quickly. Without terribly much foreign administration or cross-border issues, which means that succession is obviously a big advantage of your international pension.
Yeah, I mean, I've certainly seen, clients, with their estates taking 3 to 5 years literally to get wound up when there's offshore assets. And unfortunately, it does get very complex. But Rex, we both mentioned cross-border a couple of times today. can you just dig a little deeper in that and explain to the audience what cross-border actually means and how important to navigate, please?
Certainly. Very, very simple. Cross-border means you in this country and your assets are in that country, and there's a border in between the pair of you. So transactions are going to happen cross-border. You're either going to be contributing money over the border, or it's going to be coming back over a border back to you, and your funds obviously sit on the other side. I think for a lot of South Africans, people have made the first step to internationalize their wealth. They've got the bank account in the Isle of Man, the share portfolio in the UK, assets sitting in the US, they're invested in global stock and those kind of things. But the reality is the account or the asset that they hold isn't South Africa. It isn't in South Africa, it's foreign. And therefore you need to start to consider, well, what's the tax position on those foreign assets? Basically on the income. But also, what's the position from a tax perspective on death, and also what's the administrative position on death? And if I can sort of distinguish between those two, on death, every country has its own laws of succession. When you die, what are the rules that apply in terms of moving assets from the deceased to whoever should be the beneficiary? And unless you have a valid will in that country, those rules take over. And lots of South Africans will have a will that says, this is my final will, it supersedes other wills and covers all my assets, including my international assets. And we feel comfortable with that. But that will, for the majority of times, is not a valid will in a country where your assets might be sitting. You've got assets in Singapore, your South African will not be valid in Singapore. So that will has to be made valid. There's a process to apply to get that will validated unless you have a will in that territory. So it's that complexity that often isn't thought about. So you've done the right thing putting funds offshore, but you haven't thought about the administrative complexities when you pass away, those cross-border complexities. And then, of course, also passing away with assets in your own name in certain territories will generate estate duty or inheritance tax in that country, and other territories it could generate wealth tax. So again, if you're looking at the more socialist states, particularly places like France and Spain, you've got wealth taxes. In places like Germany, if you're owning German stock and things like that, you could have forced heirship, which means that your firstborn son might be very happy with the outcome because they inherit most of the funds, but the case in point, they haven't gone where you wanted them to go to. So I think those are the cross-border things that people tend to overlook, Anthony, and those are the challenges.
Yeah, and also, you mentioned holding equities in your own name. And Cyprus tax is something that a lot of our clients, when we first speak to them, they've never heard of it. And when you explain, their jaws sort of, drop and hit the table. So probably worthwhile me just mentioning Cyprus tax briefly. So Cyprus tax, in essence, is if the asset is on site in a foreign country, they have the first taxing right to that upon you passing away. If we use the US and the UK as an example, what are the assets that would be on site? It would be a property that you hold, a bank account that you hold, shares if the company was incorporated or the share register is in that company. So what happens then when you pass away? The US, for example, is a 40% estate tax, and that's applied to those Cyprus assets, and there's a very low threshold. The threshold is $60,000. So anything above $60,000 is going to be taxed in the US at 40%. The UK has got the same thing. It's an inheritance tax, also 40%, but the threshold is a little bit higher. It's £325,000, and that can roll over to the surviving spouse. So in essence, anything over £650,000 will be taxed at 40%, but in the US, it's when that first spouse passes away. So quite a sort of eye-opening discussion to have with clients that have held, Apple and Microsoft, etc., Google, Amazon for many years, and they're sitting with significant assets, and they don't realize that when they pass away, there is this tax coming. It's not a potential tax. It is a tax coming, and the onus is actually on the executor, to wind up and to tell the foreign jurisdiction about these assets and to submit the tax. There's no double tax. You're not going to pay the tax in let's say the US and in South Africa, because of double taxation treaties, but the executor has to know to be able to apply for that credit. And a lot of European assets don't have that double taxation treaty, and you could end up paying a lot. The state tax can be up to 60% in some European countries. So Cyprus tax is something that definitely needs to be, as I mentioned earlier, understood and properly planned for.
Yeah, I think an interesting point. Sorry, Ant. I think an interesting point. Yeah, interesting point on double tax treaties. A lot of people assume that South Africa's got a very good double tax treaty network. Yeah, an excellent DTA network. But those DTAs do not apply to matters of death. They only apply to matters of income. We only have two tax treaties, death duty treaties, one with the US and one with the UK. So there isn't anything in place with other countries, whereas tax treaties, DTAs, respective income, obviously we got 50 odd. So there isn't intergovernmental agreements to deal with matters of death, which makes it far more complicated. I think the other thing I just thought worthwhile picking up, a lot of people will say to me, well, I don't have to worry too much about Cyprus because my account's in a joint name. I've got it in a joint name with my wife. That's true. Up until the point that your spouse eventually passes away. So joint accounts, you know, they end up with those issues on the demise of the final party. But I know a lot of people think that a joint account gets around all of those issues, when in actual fact it doesn't really achieve that.
Great, thanks for that, Rex. Okay, so what we've heard so far, and I'll summarize everything at the end, but has been very positive. Obviously, multiple benefits with using pensions are very clear, but there are, however, some naysayers that are saying that international pensions are nothing more than trusts, and that South African residents who utilize these pensions do run the risk of getting into trouble with SARS or tax authorities. So I think, Rex, if you it would be worthwhile you talking about that.
Yeah, Anthony, I think, as I said at the start of this, that international pensions come in lots of shapes and forms, and I think that's part of the challenge for people, is to understand when it is a real pension and when isn't it. And I think that's part of the problem. I think if we sort of look at this sort of from sort of two perspectives, just because a pension is a foreign pension in another country doesn't mean it will be viewed as such in South Africa. And if you're living in South Africa, the most important law is the law in the country you live. So it's how will South Africa view the vehicle that you've gone into. What's very interesting really is I suppose is if you look at our legislation here in South Africa, we've got two distinct bits of legislation. Since you talked about trusts, Anthony, we've got the Trust Property Control Act, which is the law that governs trusts, and then we have the Pensions Fund Act on the other side, which is the law that governs pension schemes and retirement plans in South Africa. And what the law does, it separates those two quite clearly. And it's quite obvious, pension schemes are there to provide benefit in retirement. Trusts have other varied reasons for existence and purpose. But in the Pensions Fund Act, we actually find the definition for what is defined as a foreign pension. So our departure point in terms of law, the Pension Fund Act defines a foreign pension, and provided that the pension that you're looking at that's from overseas meets the definition of a foreign pension in terms of the Pensions Fund Act, that's the channel that you're going to go down. If it doesn't, you're probably going to be looking at that you're actually dealing with a trust that's dressing itself up as a pension, and that's what you really want to make sure you avoid. I would say, obviously, that's why you'd want to utilize regulated providers in South Africa, because you're not going to get yourself into trouble. But that's my pitch for the day, Anthony. So that's your sort of departure point. I think the other point to remember is that most pensions have a trust deed and most pensions have trustees. It doesn't mean they're a trust. Again, it depends on how the law sort of deals with them. And actual fact, if you look at our Income Tax Act, there's a section in there that recognizes international pensions. If you look at the DTAs that South Africa has, typically Article 18, 19, their international pensions are recognized in there. And if you actually look at some of the conduct regulation in South Africa with regards to financial services, you will also see that the law exists to transfer your South African pension to a foreign pension, and indeed to transfer a foreign pension to a South African pension. And those provisions have been around for many, many, many years. So there's a very well-defined and developed legal network in South Africa which governs foreign pensions. The key being that you fit into the definition as a foreign pension, so that you can ensure that you benefit from the correct treatment. On that comment, before everyone starts thinking, great, I need to move my pension offshore, it's not that simple. It has to be part of immigration, and there's an awful lot of tax to pay. So, but the mechanism, I suppose, is there. I think it was also quite interesting to, on this point of the validity of foreign pensions. So we have a mechanism there in place, a legal mechanism to deal with foreign pensions. But what's the validity of foreign pensions in South Africa? This point about getting in trouble with the tax man. I think if we look at, I suppose, News 24 in May, the retired High Court Judge Dennis Davis, who's now a consultant with SARS, he specifically commented on foreign pensions. And what he said is that, he said basically South African residents are welcome to use them. But there are a few points that he raised. He said, first and foremost, make sure you're using an authentic one. So make sure it's a genuine pension scheme, and I think I've sort of addressed that. But then he went on to make a few other further points in relation to that. One is how you use it and what you're using it for. And he was saying, make sure it's a genuine pension scheme and use it for what it's intended. And as part of that, he alluded to the investment. So what he's alluding to there is that you should, in a pension, you'd expect to find stocks and shares, collective investment schemes, that kind of stuff. But so if you're sticking to using your pension as a pension, you're in a good place. If you start to use a pension to structure highly personalized assets, and therefore you're trying to use the vehicle to achieve some other form of aim, you're probably going to find that you're going to start to get yourself into potential issues, because you're no longer using the pension for what it actually is intended. So I think it's very encouraging to see what he had to say with regards to pensions. I haven't got his exact words here, but he basically said if you can get a good one and a good provider, crack on and use them. And it was almost, I'm not paraphrased, but it's almost exactly what he said. So I think it comes down to, if you're using a proper pension scheme for all the right reasons, there's no reason why you shouldn't use one. And I think if you look at the number of applications we get through the Reserve Bank for additional contributions into foreign pensions, which is the Reserve Bank authorizes in terms of special applications, it's quite clear that there's no issue with funding a foreign pension from a South African perspective.
Okay, Rex, I'm actually going to jump to a question. As you were talking, a question came through that talks to that one point that you raised of the investment. So the question is, can you invest in private companies out of your offshore pension? If I can answer that, so the answer is you can, but it has to be a justifiable overall percentage of the portfolio. It has, this is a pension, and within a pension you do need more traditional assets. So if it's a smallish holding and it's an unlisted entity or private equity type company, these pensions do have quite wide investment mandates, but as per Judge Dennis Davis's comments, the assets there have to be for retirement purposes. They have to be able to generate income in retirement, and illiquid assets, don't tick that box. So yes, you can, but it has to be a small enough portion of the overall portfolio. Is that about right, Rex? Would you want to add anything to that?
I fully agree with you, Anthony. I would say one other thing to consider is how connected to that private equity are you. So if you're setting up a company specifically to put inside the pension to hold some form of asset, because your motivation is, I suppose, potentially to create some tax advantage that you wouldn't otherwise get, I think that's what you're trying to avoid. So if you look at South Africa has signed up to the OECD's initiative on BEPS, which stands for base erosion and profit shifting, and those kind of arrangements are frowned upon by SARS. But if you're buying into private equity, you might be an employee of a private company, and you can get some company shares in there. It's not personalized assets. It's private. It's proper private assets. And there's a distinction between personalized and I would say non-personalized private assets. And so non-personalized private assets that, yes, you could hold them in the pension scheme, as Anthony said.
All right, great. And this has been going now, these products for about 15 years now. So they've had there's some really good track record with them. Obviously, people set pensions up or international investments for various reasons, over the years. If we have to fast forward to the last couple of years, Rex, in your mind, what are the main reasons or trends that people are using the pension for?
I'd say I think we see in terms of why South Africans are setting these up. I think I talked a little bit about the outcomes that people want. They want peace of mind. They want to internationalize wealth. They want to ensure that funds are dealt with on death. A lot of people have become, I'd say, Anthony, have become savvy to all the points we talked about cross-border. And whilst we talked about those, we didn't talk about the implication of pensions for them. And very simply put is, if you pass away with your foreign pension, irrespective of where those assets that sit inside the pension might be cited, as Anthony said, your pension scheme is not subject to foreign death duties or estate duties or wealth taxes. So all those tax aspects that would happen will be crystallized by your death simply do not apply, because the pension scheme isn't the one that's dying, it's you that's dying, and you're removed from that. You're simply the member of the pension scheme. So I think, Anthony, I think that point around cross-border, we're seeing a lot of people using pension schemes to consolidate assets. So they've done all this. They've got assets all over the place offshore. They're now going, right, now if I consolidate those assets, I've still got my investment portfolio. I've still got that. I've just consolidated into my pension scheme. I've done two things. I've addressed all of those cross-border issues, which means when I pass away, there's no need for foreign wills. All of those potential taxes fall away, and there's seamless succession to the people that needs to get it. And you can probably speak from experience how quickly this happens, but it is a pretty quick process, and the people that are dependent on you or you want to have those assets get them, so that the emotional issues that come with having to wait for estates to wind up and the financial issues are simply done away with, together with all the cross-border stuff. So I think that succession piece, driven by consolidation of assets, Anthony, is a big place. So that consolidation and looking at succession, and of course the asset protection. Once it's in there, your assets are protected. If something happens, your money's safe. So I think that's we see that. So consolidation is a big one. The other one, and that we Anthony, that we see is people going offshore for the first time. I think a lot of people like the security that a foreign pension brings. It's a regulated structure. There's, it's subject to the ombudsman, all those kind of protections that you'd expect a pension scheme to have. Your foreign pension scheme should have them, so that there's recourse. The pension company is accountable, and there's recourse. And of course, if you a firm like ourselves, which is regulated in South Africa, you have recourse in South Africa, not just the foreign jurisdiction. So a lot of people, first timers going offshore, it's about that sort of recourse, accountability. So yes, people wanting to internationalize for the first time, choosing pensions as the preferred vehicle, consolidation of wealth. And then we're also seeing a growing trend with regards to people that have set up trusts. Now, a lot of offshore trusts were set up in the 90s, really as a mechanism to protect assets in the event that South Africa ended up the same way as Zimbabwe. Now, the great news is we haven't ended up the same way as Zimbabwe. We've still got a very strong and growing economy. It's still a very well respected country is South Africa. So even for all the things that we've got that go wrong in our country, it's still a good place, and there's a lot of wealth can be created here. So what we're seeing is those trusts that were set up many years ago. People starting to restructure those trusts, because those trusts weren't really set up for the benefit of the beneficiaries. It was for the benefit of the sector. They were using them to protect themselves from potential political risk, which never manifested. Yeah, it never manifested. We came close, I think, but it never manifested, which was the great thing. So the intention is that you always wanted to have access to that money. You always saw it as yours, but you put a trust in place. And pension schemes are set up specifically for you to be the person that benefits from it. Trusts really aren't. They're really set up to have for other people to benefit from it. So the pure international pension is a far more appropriate vehicle. It provides the same asset protection, but it's there for you. And therefore, I suppose from that perspective, it makes far more sense. And if you have a trust, you're the settler, you're the beneficiary, the protector on it. From a South African perspective, from a tax perspective, it's questionable whether that trust actually exists. So I think for a lot of people, the better vehicle is pensions. So we're seeing a lot of conversions from trusts into pensions. You still get all the same protection, but it's the right vehicle. You're not going to get served to hot water from a tax point of view because it's not run right. So I think that's the other thing. And then I suppose Section 7C, which now sees the loan that might have been used to fund that trust, obviously drawing deemed interest, and therefore having a new tax liability in respect of those loans. Again, those don't exist with the pensions. So those loans are being repaid, and people are then contributing into the pension scheme. So yeah, so those are it. Consolidation, winding up those old trusts, which are expensive and no longer efficient, and first timers looking for a safe place to go. Anthony.
Perfect. Let me take us a minute or so just to summarize and consolidate everything that was said, because I think we do need to bring it together. So in essence, an international pension that would be administered by Overseas Trust and Pension would sit in Guernsey. It's regulated by the Guernsey Financial Services Commission, the Guernsey tax authorities, and the pension regulator in Guernsey. And as you mentioned, Rex, especially for first timers that are going offshore for the first time, they really like that regulation. I mean, Guernsey has been a stable democracy for, I think it's over 950 years now. So that safety and security is paramount. Let's talk about contributions going into the pension. You mentioned that there's no tax deductions. I think that's pretty clear. The contributions can be ad hoc lump sum, so you can make one contribution and then no further contributions, or further contributions if you get a nice bonus, or you sell an investment or an inheritance, etc. There's no loan that you mentioned. There's also no donations tax because there's nothing gratuitous. This is your pension. So that really summarizes the contributions. And you said as well that there is no limit. So if I can just expand on that, from South Africa, you'd be capped at your South African Reserve Bank allowances, but from existing offshore assets, there's absolutely no limit. And a lot of clients like consolidating all of their assets offshore, into their pension. Once it's in the pension, full asset protection from creditors, as you mentioned. From an investment perspective, we refer to it as open architecture. So pretty much any traditional assets, so you can hold shares in companies, you can hold bonds, you can hold ETFs, you can hold unitized funds, you can hold commodity funds, REITs. So very, very wide. And then we touched on a portion being able to hold more illiquid type assets. You mentioned gross roll-up while the assets are sitting within the pension, which means there's no income tax payable in Guernsey unless you become a Guernsey tax resident at some stage, but no income tax in Guernsey and no income tax in South Africa while that income is sitting in the pension, and no capital gains tax either. That's quite nice because you don't have the tail wagging the dog. I mentioned people holding Apple shares, for example. I've got some clients that don't want, or they want to sell some of their Apple shares because they want to diversify, but they don't want to trigger that capital gains tax. Whereas when the assets are inside the pension, you can buy and sell without having to worry about any tax consequences. You've got full access to that money, as you mentioned, from age 50. The pension pays those benefits in very tax efficient ways. And then on succession, from a succession planning perspective, also a huge amount of efficiencies. So as an example, seamless succession to your beneficiaries. I've seen beneficiaries receive money from a Guernsey pension within 2 weeks. Contrast that to 4 to 5 years. Even contrast that to 2 years. You know, the fundamental, you know, the essence of getting this, you know, almost immediately is just so powerful. No need for a foreign will, no Cyprus tax, no executive fees, no capital gains tax, no probate where a South African executor has to, you know, wind up the whole estate, and lots of estate planning and estate tax benefits as well. Importantly, though, and you touched on this, and as per Judge Dennis Davis, these pensions have to be suitable. They have to be set up for the right reason. They do need to be a pension. Clients do need to draw down on them, and it should be treated as such. So that's just a high-level summary. Anything that you want to add to that, Rex?
Yeah, I think just 2 points really. And when you receive your pension benefit in South Africa, there is tax on what you receive where you are receiving those gains that Anthony was talking about. So it's not a tax-free ride. There's no such thing as a tax-free ride anymore. So when your pension does pay out in the same way as your RA pays out or your living annuity, there will be tax applied on that investment income. So if it's capital gain that's being paid out, to pay CGT. If it's interest, you pay your income tax. So there is eventually, you will have your tax liability on the distribution of the growth when it's ultimately paid out. So the other thing I think is very worthwhile pointing out or just mentioning is portability. We see so many families, moving out of South Africa because the kids have gone overseas, they've studied there, and now the grandkids have arrived. So people want to be able to move. And yes, there are people that emigrate for work reasons and other personal reasons as well. So, but the beauty with your international pension scheme is that it's highly portable. You can choose to pretty much go anywhere in the world, and you don't have to reorganize all your affairs because you're moving from one country to the next. So if I'm moving from South Africa, say for example, to Australia, I'm going to have to change my pension arrangements here. I'm going to have to cash those schemes in because it doesn't make sense drawing a rand-based pension when I'm in Australia. It doesn't make sense. So, but if you've internationalized those assets into a pension, whether it's Australia, the UK, or somewhere in Europe, or another country, you can draw down on those pensions in the currency that you need to draw down on. So for people that have an international lifestyle or considering immigration, or even though it might be not formal immigration, but spending significant times abroad, you've got that international portability that pension brings. And in most developed countries around the world, your foreign pensions, which could be pensions from the country next door or a true international pension, they all treated very similar to their domestic schemes. In other words, governments respect pensions and they treat them accordingly, which makes them very compatible in most countries. Not all, but most. And the thing is, if you happen to go to a country, Canada, you choose to go to Canada, you like the prairies and 40 degrees below, you're going to go to Canada. It doesn't make sense to have an international pension when you move to Canada for various reasons. But the beauty of your international scheme is you just cash it all in and you take out and you reorganize your affairs once you're in Canada. So you're not stuck. So ultimately you've got the ability, or you can transfer your international scheme into a domestic scheme, provided the domestic laws cater for it, which most of them do. So lots and lots of flexibility in respect of, I say, the portability of your pension. So whatever happens in your life where you choose to go, it sort of facilitates things around that.
Yeah, and there are certainly jurisdictions where an international pension works absolutely brilliantly. So depending on where you want to move, you come to a Carrick advisor, we have a proper discussion around that. Worst case scenario, as Rex mentioned, if it doesn't work in that country, you do have the ability to close down that plan. Okay, so we're actually spot on 45 minutes. I want to answer some questions. What I thought of doing is first just running quite quickly through some more frequently asked questions that we get. And while I'm doing this, please feel free to post questions on live. And also these are also some questions that we have received in advance. So the first one is how am I taxed if I invest offshore in my own name? So, we have touched on that in the webinar, but probably worthwhile just pointing that out. So, investing in your own name is the least efficient. So you'll pay income tax at your marginal rates on any income as and when it's earned, and you'll pay capital gains tax at your capital gains rates as and when any gains are crystallized. Creditors can access those investments if you do get into trouble. We have clients signing sureties, for example, all day long in their businesses, or taking risks if they're directors. You've got the Companies Act, joint and several liability, etc. So owning assets in your own name, not great while you're alive, and when you pass away, well, then we discussed all the absolute nightmare, literally, of winding up estates. So not efficient. Generally, we only we only advise clients to invest in their own name if they're not quite sure what they're going to do with that money. And if they say to us, in the first couple of years, I might want that cash to buy a property, or I might be leaving the country, then fine. But generally, structure does make sense. And as I mentioned, it's not just international pensions. There's a whole host of other products, and we find the one that best fits the client's objectives. Next question: what happens if I leave South Africa? Rex, I think you've covered that perfectly. So let's move on from that. Third question: can South Africa ever call back the money that is in a pension, even in an absolute worst case scenario? So you did touch on that, but I think worthwhile talking about that a little more. The answer is no. Once that money has been externalized using your allowances and it's sitting inside a pension, South Africa can never ever call that back. And that's very different to asset swaps. Even some international endowments provided by local insurers, sometimes they do have the ability to call back those assets. So there's always a thin line back to South Africa. If your primary objective is to mitigate political risk, you certainly don't want South Africa to be able to call back the assets. So pension.
Yeah, interesting point on that, Andy. Obviously, as we see that happening all the time, that companies have to keep their levels in terms of foreign exposure in line with what the Reserve Bank prescribes. So we're seeing assets constantly being repatriated to South Africa. Within the life insurance companies and the big investment companies, we see that happening all the time. So the assets are called back on a frequent basis. But I think once you've externalized your funds using your personal allowances, those exchange control requirements do not apply to those funds. You've got the money has been sent offshore. And then doesn't apply. So I suppose it shows that offshoring your assets through a domestic arrangement leaves you at risk of changes to the exchange control environment. And I think that's I suppose the point. So you can access offshore assets domestically, but you've got extra complexity because you have to worry about what's going to happen with the exchange control. And who knows where it's going to be next year, where it's going to be in 10 years, 15 years, those kind of things. So it just takes a layer of complexity out.
Yeah. Thanks, Rex. Next question is, do I have to take payments from the pension? And do the payments need to be made in South Africa? So first of all, I mentioned earlier that you do need to take drawdowns from that pension. It is a pension. It needs to provide income for you in retirement. And that is the objective. So the answer is yes. And do the payments need to be made back into South Africa? No, the payments can be made to any bank account in your name anywhere in the world. So we often have clients that will have an offshore bank account already established. They might want to take their families on a nice holiday, or they might want to draw down some income for expenses in South Africa. So depends what the needs are. You can get paid back in South Africa or into your international bank account. Next question is, what tax reporting is there? So Rex, I'm going to hand it over to you.
Yeah, pensions are highly transparent vehicles. There's, I suppose, three sort of types of tax reporting. Obviously, if you receive a benefit, We report to you so that you have your tax certificate, so you can submit that to your tax authority to demonstrate, which will show either you've had capital out or income out, so you get taxed appropriately or not taxed, however it might be. So that's individual tax reporting. Then the scheme itself is subject to common reporting standards. So you have your common reporting standards, which is tax authority to tax authority reporting. And then in South Africa, we have a bit of regulation called reportable arrangements, which really requires any South African who's going to be investing in excess of 10 million offshore into certain type of arrangements, of which pensions would fall under those. There's a one-off report that gets made to SARS to confirm that you are doing that. So those are the three types of reporting that are in place in respect of tax.
Fantastic. Another question, how long does it take to set up? What information do you need? So it can take as quick as 2 weeks. I'd say on average 3 to 4 weeks to set up. The delays that we see is what we call source of wealth. So as you can imagine, the trustees need to, and Carrick compliance need to make sure that all boxes are ticked with regards to anti-money laundering. So we need to see how you manage to accumulate that wealth. If it was a sale of a business, we need to see proof of that. If it was a sale of an investment, same thing. If it was savings or from earnings or salary, we want to see some pay slips, a bonus, a dividend, etc. And that can cause delays, but we do make that very, very clear to our clients up front as to what they need. If you submit everything and it's a clean case, like I said, it could be as quick as 2 weeks, but bank on 3 to 4 weeks just to be safe. I'm just looking at some questions and conscious of the time as well. I think we've got time for 2 questions that have come through. First one, what credit risk am I taking to Carrick and to overseas trust and pension? So Rex, if I can take this. Also, again, a very quick answer. You are taking no credit risk to Carrick. What credit risk means is if Carrick goes bust or if overseas trust and pension go bust, what happens to my investments? So this is your structure. Carrick are advising you outside of your structure. So if Carrick disappear, makes no difference. Your pension carries on. With respect to overseas trust and pension, so they, as I mentioned, are highly regulated. They have to hold a certain amount of capital. There's audits, regulator visits, etc. But if something happens to them and they close their doors, practically what happens, the regulator comes in and assigns your pension to another pension trustee in Guernsey. So you are taking no balance sheet risk. And that's a very important point, actually, because there are certain other products where people don't realize that, hold on, I'm actually taking that risk. And I was working in a bank in New York. I was there through the global financial crisis. I've seen very big companies go bust overnight. And if you can structure around that risk, highly recommended that you do. Okay, next question. Rex, this one will be for you. If South Africa brings in a wealth tax, would assets in the pension be subject to that tax?
Thanks, Anthony. I can see why you passed it my way. I mean, who knows is the answer. How long's a piece of string? However, saying that, if you look at the discussions that have been had around wealth tax today and some of the consultation, whilst there's a general belief that there should be a wealth tax, there are certain things that have already been put on the table to be excluded. And your primary residence, the value of your primary residence is one. And your pension is another. So, and I think that makes sense, because if you start including pensions in wealth tax, well, you defeat the whole purpose of the tax, because the tax is to tax the ultra high net worth individuals in the country and not everybody else. And the biggest source of wealth for most normal people is their property that they live in and their pension, and those sustain them. So the idea is that wealth taxes shouldn't extend to pensions. So that bodes well, I suppose, for things. And if we look at a lot of the OECD countries, those that still have wealth tax exclude pensions. So if I had to sort of look at it and take a guess, my guess is that if a wealth tax is introduced, you'll probably find it'll follow what we see elsewhere in the world, and pensions and primary residences will be excluded from that. But who knows?
All right, perfect. Thanks for that. I think let's wrap it up. We're almost on the hour. Rex, great session. Thanks very much for all your valuable input, and also to our listeners, thank you very much for dialing in. This will be recorded, so we can send you a recording if needs be. Just let us know. Clearly, and this is what I say to all of the Carrick advisors, every single client is different. I highly recommend, if this is something that you're considering, to understand the options, understand all the options, and all the various aspects of that, to make sure that your circumstances, that it works, and that it's the right thing for you. We have seen situations where clients go into a pension, it's not the right thing for them, and then there's some very unhappy people at the other side of it. So thanks again for all your time. Please reach out to your Carrick advisor or email us at wealthmanagement@carrick-wealth.com. Let's call it a day for that. Have a great day further, and thank you all again for participating.